This chart maps the Federal Reserve's balance sheet over a 14-year period. Before the financial crisis in 2008, the total value of everything the central bank owned sat at under $1 trillion. Then, wave after wave of intervention pushed that number upward, until by the spring of 2022, the balance sheet peaked at nearly $9 trillion. When an institution creates roughly $8 trillion, the public reaction is usually alarm. Headlines often use the phrase money printing, and it brings to mind physical banknotes violently rolling off industrial presses. Over the last decade, that exact image fueled loud predictions of imminent runaway hyperinflation. Yet for more than a decade after the initial 2008 crisis, the predicted wheelbarrows of cash never materialized. Prices did not double overnight. The money existed, and the numbers were publicly available, but the inflation simply did not arrive. Understanding why prices stayed flat while trillions of dollars were created requires us to look past the printing press metaphor. We need to track exactly where that digital money went. To see how this system actually functions, go back to Japan in 2001. A standard rule of central banking is that when an economy weakens, you cut interest rates. Cheaper borrowing costs encourage businesses to invest and households to spend. That is the ordinary lever. But the Bank of Japan faced a severe problem following the collapse of their asset bubble. Short-term interest rates were already pinned near zero. The economy was still locked in a grinding decline, and the central bank had completely run out of its usual ammunition. So they tried something novel. Instead of targeting the interest rate, the price of money, they started targeting the quantity of money. They intentionally flooded commercial banks with billions in excess reserves, hoping that drowning the banks in spare cash would make them eager to lend it out. This was quantitative easing. It was a desperate experiment born out of necessity. But 7 years later, when the global financial system fractured, central banks around the world used that exact experiment as their primary blueprint. Despite the name, no physical cash is ever minted in this process. A central bank creates money electronically, through a simple keystroke that credits an account with funds that did not exist a second earlier. This flowchart tracks how that new money enters the financial system. The central bank takes those freshly created digital reserves and goes into the market. It buys government bonds from commercial financial institutions, taking the bond onto its own balance sheet and handing the seller the new cash. Now, an investment fund that used to hold a safe government bond holds cash instead. But cash earns almost zero interest. The fund is forced to go looking for yield-bearing assets. Researchers tracing this flow found that more than 60% of those original proceeds get reallocated into corporate debt. Economists call this portfolio rebalancing. As massive amounts of this central bank cash chase those corporate bonds, it bids their prices up. Mathematically, when bond prices rise, it pushes their yields, the actual borrowing costs for the companies, down. This chain reaction connects the digital keystroke to the real world. By forcing borrowing costs down across the system, debt becomes significantly cheaper. Companies issue more of it to build out cash buffers, expand factories, and hire workers. If this transmission chain works, it still leaves the inflation question unanswered. Why didn't that $9 trillion flood the wallets of everyday consumers and wreck the value of the dollar? Look at this cross-section of the financial system. The trillions of dollars the Federal Reserve created did not pour directly into local shops. The money pooled inside the system, right here in the reserve accounts of commercial banks. The banks held the reserves, but they were hesitant to push them aggressively into the real economy as consumer loans. Economists measure how quickly money changes hands using a metric called velocity. While the central bank was rapidly filling the reservoir with new reserves, the velocity of money actually fell. The liquid existed, but it sat perfectly still. The inflation that eventually hit the global economy in the 2020s was driven by entirely different mechanisms. It was the result of severe supply chain shocks from a global pandemic, snarled shipping lanes, and direct cash payments sent immediately to households. Creating digital reserves to buy bonds is a different act from handing freshly minted cash to citizens who will spend it tomorrow. Conflating the two hides the actual mechanics of why prices rise. There is a heavy cost to this mechanism. When a central bank drives yields down and forces money into corporate bonds, that immense capital inevitably spills over, inflating the price of equities and sending the stock market climbing. This creates an uncomfortable mathematical reality. The vast majority of stocks and bonds in the economy are not owned by average households. They are overwhelmingly held by the wealthiest fraction of the population. By stabilizing the economy and keeping borrowing costs low, quantitative easing genuinely aids the bottom 90% of earners who rely on a stable job market. But simultaneously, by inflating asset prices, it concentrates immense wealth at the very top. When a central banker defends the policy, they point to the job market. When a critic attacks it, they point to the widening wealth gap. They are both looking at the same outcome from different sides. This process is also reversible. This is quantitative tightening, the part of the experiment that proved it was never a permanent printing press. On this ledger, when the central bank decides to drain money out of the economy, it stops replacing bonds it owns as they mature. The bond expires, and the digital money originally created to purchase it simply vanishes from the balance sheet. That symmetry matters. This is a deliberate, reversible set of plumbing that can expand and contract on demand. It is distinct from a government physically printing cash to pay its debts, which cannot be unprinted once it enters circulation. Over 2 decades of testing, the ultimate limitation of this tool has become clear. A central bank can effectively dictate terms to financial markets and calm a panic, but its power to organically raise wages or permanently boost economic output remains highly unreliable. The digital money created over the last 20 years eventually vanishes from the ledger, but the ownership of the assets remains. When the dust finally settles, the only enduring consequence is who is still holding them.